All right, everyone, welcome back to our financial reporting series. In today's session, we are going to look at a very important topic, types of business entity. When we talk about business entity, we are simply referring to the different ways a business can be owned. Types of business entity, right? So, when we talk about business entities, we are simply referring to the different ways a business can be owned and operated. And understanding this is extremely important before we learn accounting, right? Because the accounting treatment depends on the type of entity, right? So, let's go through the three main types of business entities one by one. The first one would be sole trader. Sole trader, let's start with the simple form of business, that is sole trader, right? Sole trader is basically a business that is owned and run by one individual, just one individual. Right now they may employ people, they may run a small shop, a consultancy, a small service business. The size doesn't matter really. What matters is that there is only one owner, right? Not multiple owners. The key thing to understand here is that there is no legal difference between the owner and the business, right? The here owner equal to the business. Owner is simply refers to the business, right? The owner and the business is not two different entities. Based on this, according to the taxes, according to the business law, it is considered, they both are considered same, right? This has two major consequences. All right, so all the profits, when someone starts a business, they obviously going to make some profits. All the profits belong to the owner, right? He doesn't have to distribute the profits to shareholders or anything, because everything is owned by the owner. Whatever the business earns ultimately goes to the owner, right? One is this property, the second one is the owner has unlimited liability, right? What do you mean by unlimited liability? That means if the business cannot pay its debts on time, the owner must pay from their personal money. All right, so the personal assets of the owner are at risk. All right, so now let's talk about the capital structure for the sole trader. Capital structure would be the owner puts more money into the business, or the business earns profits, right? And the capital account decreases when the owner takes more money out for personal use, which we call drawings, right? The business makes a loss, right? That's very simple. Second one is partnership. In partnership is a very similar to a sole trader, except that here we have two or more partners, right? And two or more partners, right? So partners share their profits, usually, and but they also share the losses as well, right? If profit comes, they will share the profits. If losses are there, then they have to share the losses as well. All right, but they share the losses, and just like a sole trader, they too have unlimited liability, right? We have, for example, in sole traders, if there is a loss, or if there is a default, that then the owner has to pay everything, right? That's unlimited liability, you can't escape by doing something, right? So they have to pay anyways. So similarly in partnership also, the partners has to pay the debt by the at the end of the day. Okay, that's why it is unlimited liability. There is one very important rule in partnership. Partners are jointly liable. Jointly liable. In sole trader, the owner is liable for everything. Whatever he does, for everything, the owner is the only one who is liable. But here, if there are two owners, if there are three partners, three of them are liable here, jointly liable and equally liable. This means each partner can be held responsible for all the debts of the business, not just their shares. So if one partner cannot pay, the other partner might have to cover full debts. Now the capital structure When it comes to capital capital structure, partnership is slightly more detailed, right? Each partner has two accounts. Each partner has two accounts. One is capital account, the other one is current account. First one is capital account and the other one is current account, right? So what happens in the capital account? This is usually a fixed amount. It normally changes only when a partner joins or leaves the business, right? When it comes to the current account, this is where the partner's share of profit or loss is recorded, like P&L. Okay, and from this current account, the partner also takes drawings, right? So the current account keeps moving up and down based on profits, losses, and drawings. So finally, we have arrived at third one, which is limited liability company, right? Limited liability company. In this limited liability company, this is very different from the first two because of company is a separate legal entity. What do you mean by that? Company is a separate legal entity. So here what happens is, that means the company has its own legal existence separate from its owner. Like in sole trader, sole proprietorship, what happens is you don't differentiate between the owner of the company and the company itself, right? Here the owner is completely separate from the company. The company is a separate existing entity. The owners of the company are called shareholders. They invest money into the company and receive shares in return, right? Now the owners are called shareholders. And what do they have? They have ownership of the company, but they are not the company. They invest in the company. In return they get shares, right? The biggest advantage of a company is limited liability. Limited Why limited liability? Because shareholders can only lose the money they invested, right? If I have bought 10% of shares of a company like xyzlimited.com, like xyz limited. So if I invest 10% 10% of shares, it costed me around 2 crores. So if the company gets into losses and the company is not able to pay the debt, what most probably what's going to happen? What's going to happen is I might lose my 2 crores. Except that I'm not going to do anything. I'm not going to lose anything, not even 1 rupee extra, because it's a limited liability. If the company defaults, I don't have to pay, take it personally and pay my personal money there, because it's not unlimited liability for me, right? They do not have to pay personal money to pay company debt. This makes companies much safer for investors, right? Also, a company continues to exist even if a shareholder dies or becomes bankrupt, right? The company doesn't stop because of the shareholders personal situation. The company keep on running. A company is managed by a board of directors, BOD, right? Who are elected by the shareholders. Shareholders elect the board of directors. So shareholders own the company, but directors run the company. All right. Now let's look at the capital structure. In a company, everything is more formal, more regulated. Shareholders cannot simply take money whenever they want. Like drawings in the sole trader or partnership, we don't have. There is no concept of drawings exist in this. All right. It only exists in sole trader and partnership. Instead, shareholders receive returns in the form of dividends. What is dividends? Dividends are share of profit. Suppose, let's say the company has made profits. For example, net profits after deducting all the expenses, operating expenses and taxes and everything, you've got net profit, arrived at the net profit of 2 crores. So in this 2 crores, the management, the shareholders and the board of directors will decide how much profit should be distributed among the shareholders through dividends. profit is distributed among the dividends, and the remaining profit which is not distributed to the shareholders will go into reserves or retained cash, retained profits, which is reinvested in the business to grow the business, right? So the capital structure of the company is strict, organized, and governed by laws. So what's the conclusion here? Conclusion is a sole trader is one owner with unlimited liability and a simple capital structure. A partnership has two or more owners, also with unlimited liability, right? And each partner has a capital and current account. A limited liability company is a separate legal entity where shareholders have limited liability and the business is run by directors. This understanding will help you make sense of how accounts are prepared differently for each type of business, right? That in business, the way you choose to structure your organization has a huge impact on your taxes, liabilities, legal responsibilities, and how much control you have. The three most common forms are sole trader, partnership, and company, limited company, like we discussed. Right? Let's understand each of these in a simple, practical, and exam-friendly way. Right? The first one is sole trader. You already know this. Sole trader, right? Sole trader is the simplest form of the business. Only one person is the owner. One person owns the entire business and makes all the decisions related to the business, right? So here the concept that we are going to talk is, like, there are two different things here. One is accounting view, right? One is accounting view. The other one is legal view, right? One is accounting view. The other one is legal view. What exactly do I mean? In accounting, we follow the business entity concept, which means we treat the business and owner as a separate for recording purpose. But but legally there is no separation. The business is the owner. There is no separation. The business is the owner. There is nothing else. And the unlimited liability. This is the most important point. If the business cannot pay its debt from business assets, the owner's personal belongings such as car, house, savings can be taken to settle the debt. That's what it's called as unlimited liability. Unlimited, right? Unlimited liability. The second one, the characteristics of this is usually they are small. Sole traders are small, right? They're not like big companies, right? Sole traders are small, limited capital, because funding comes from only one owner. If there is only single person, how far can he fund, right? And it's very flexible. The owner can run the business as they want. Owner can introduce or remove capital anytime, right? So what could be the advantages now? If there is only one person, advantages are, most probably, he can have full control, right? Full control, because he's the only one who is making decisions. Easy to start, right? And if there is only one person and he has to do everything by his own and there is no restrictions, so no legal formalities. There are legal formalities, but there are very less compared to companies, right? So when it doesn't involve hierarchy or when it doesn't involve bureaucracy, which means the decision has to taken by only one person, so it doesn't have to follow a protocol, right? Quick decision making. Quick decision making, right? So what could be disadvantages? If there is advantages, there will be a disadvantage as well. So what could be the disadvantages here? First one is unlimited liability. Unlimited liability. And when there is only one person, when there is no support, the resources are limited, right? Limited resources. And business may stop if the owner falls sick or dies. Everything is dependent on only one person. If he is dead, if he is gone, the business is gone, right? So this is the case with respect to sole trader. When it comes to partnership, When it comes to partnership, a partnership is similar to a sole trader, but with two or more people sharing ownership, like we discussed this earlier, right? But here we have to talk about accounting viewpoint and legal viewpoint. So legal position is that here, just like a sole trader, the partnership is not separate from the partners legally. So partners also face unlimited liability. Unlimited liability, right? If the business can't pay debt, the personal assets of the partners can be used. Personal assets can be used here as well. So why partnerships are better than sole traders? What could be the reason why partnership are better than sole traders? Because there is more capital. Why there is more capital? Because not one person, more than one person is involved here, right? When there is people, there is capital, there is skill, there is knowledge, and what else? There is ideas, right? And they share workload could be shared, right? And lower administrative cost, right? Admin cost would be reduced. And continuity, if one partner is unavailable, others continue the business. So continue. And capital rules could be partners can bring in or withdraw money only with mutual consent. This is very important, mutual consent, right? So the third one is company, right? Company. What could be probably a company is completely different from the first two structures, which we have already discussed. So this is also called as separate legal entity, which is different from the business owner, right? A company is treated as a separate person in the eyes of law, which means it can own property. When in sole trader, your property, business property is same, but here the business can own property. When a business is owning a property, that doesn't mean it's your property, it is the property of the business. Okay, it can enter contracts on the name of the business, right? On the name of the business, on not on the name of the owner. It can sue and be sued, right? It is responsible for its own debts. Shareholders are not personally liable, it is limited liability. Limited liability. Major differences compared to sole trader and partnership are: one is property ownership. Property ownership, like if the company owns assets, they belong to the company, not to the shareholders. Even if ownership of shares changes, company's property does not change hands, right? And what else could be transferable shares? What exactly I mean transferable shares? Shares is most companies can be bought and sold freely. In partnerships, you cannot add or remove partners without everyone's consent. Legal actions. Legal actions. A company can go to court in its own name. Court decisions affect only the company, not its shareholders personally. Okay. And what can the company do? Raising funds, raising finance, right? To run the company. Companies can raise loans more easily and can offer floating charges, a type of security over changing assets like inventory. Individuals and partnership usually cannot do this. They cannot raise funds so easily. And what else? Taxation. Companies pay corporate tax separately, not income tax. Corporate tax, what companies pay. Income tax is something an individual pays on his income. Okay. Shareholders pay tax only on dividends. Sole traders or partners pay personal income tax on the whole profit. So, what could be disadvantages? Disadvantages of being a company, right? What could be the disadvantage? Even though companies enjoy limited liability and strong financial options, they also face more rules and obligations. right? What are the rules and obligations that they face? Registration formalities. Registration formalities is a company must be registered and incorporation documents must be filed. Legal and registration fees must be paid. This is a primary task. And what else? Annual reporting requirements. Annual reports. Company has to make annual reports. I would say companies must prepare annual financial statements, file them with the registrar. In many countries, get them audited. This increases administrative cost. All right, it takes a lot of time, money, and effort to build this kind of reports. And public disclosure. Company accounts and documents are open to public inspection. Sole traders and partnerships do not have this requirement. All right, restrictions on capital. Capital restrictions. Companies have strict rules for introducing capital, withdrawing capital, distributing profits as a dividends. Right? It's not a one-man decision. It has to approved by the board. Separation of ownership and management. Separation. Shareholders cannot manage the company unless they are appointed as directors. Partnerships do not have this restriction, right? So finally, what I'm trying to say is sole trader simple structure, full control, unlimited liability. Partnership, shared resources, shared risk, still unlimited liability. But where it comes to companies, company is a separate legal entity, limited liability, more regulation, a hell of a lot of rules, right? So that's it for this video, and let's meet in the next video.